Okay, hello everyone, and thanks for joining me. All right. So today I will talk about this corporate presentation by Cardinal Energy, and I will focus on SAGD development that they have in their slide deck. So Cardinal Energy, you can see, so all this information is publicly available. You can just go on their website and see the same slide. But I think the focus today is going to be mainly on the new greenfield development. So this is a little bit of a background to, maybe I'll minimize myself a little bit, to their shares. They have 161 million shares. The market cap of this company is about $1 billion. And net debt is close to 191 million. So that's the value. And they produce close to 22,000 barrels a day. So that kind of gives you a scale of a company. So even from economical perspective, if you want to understand the company a little bit better, that kind of gives you a perspective. So if somebody was to come and buy this company, they will have to add the debt to the market cap. So let's say the company value is 1.3 billion or so, and it produces about 22,000 barrels a day. They do have thermal development. So you can see here, thermal development expenditure forecast, 2025, about 120 million. And they already spent some money on this project. So they're developing a greenfield project called Reford in Saskatchewan. So we're going to learn about that. You can see here they disclose a little bit about their strategy for SAGD development. So year-end 2024, total proof plus probable reserves grew by 30% year over year with formal recognition of Reford SAGD project. So they kind of mentioned that, and growing portfolio of thermal projects. So they want to really kind of grow more of that business for Cardinal Energy. So this is their production, current production, where it's coming from. So you can see at the bottom, natural gas. They have portion of natural gas, which is in gray. And liquid is kind of that reddish color. So in overall, it's close to that 22,000 barrel a day operation, right? So 21,300, 21,700, something like this. And here you can see kind of the partitioning of their assets, right? So, okay, maybe I'll add myself here right there. Yeah, so you can see me. So you can see the Alberta map on the west side, and east is Saskatchewan. So you can see the focus of today's presentation is going to be on Reford SAGD, which is kind of in the midsection. You have Central Wainwright, the northern kind of business they have, and southern business in South Alberta, and the Smithdale asset right there in, on the east side, southeast side of Saskatchewan. So you can see for each box kind of what where the production is, right? So about 3,570 BOEs per day in Saskatchewan from that green box. And what they do in Smithdale, they have large miscible Mississippian CO2 EOR flood. So you guys learned about that, like enhanced oil recoveries, right? So they use CO2 to basically push the oil. And they talk about numerous opportunities to expand when compared to neighboring analog pools. And West Saskatchewan, they have thermal oil trend. That's the 6,000 barrel a day Reford SAGD asset. So you can see it in the kind of central Saskatchewan, I guess, West Saskatchewan. And this is the greenfield development for 6,000 barrels a day SAGD. And that's really the topic of our project, Steam-Assisted Gravity Drainage development. This is unlike any of their other assets, right? Because you can see also like north region, which is that kind of not blue, but what is that color? Kind of the north side, I guess. If you look up north, they have 7,210 BOEs per day, which is legacy large pool of light oil pools using water floods with corresponding low decline, and existing multi-leg medium gravity crude opportunities in that region as well. But it's far, far away from the Reford SAGD asset, which is in Saskatchewan, that has more of that bitumen kind of viscosity and recovery scheme. So really nothing to do with the light oil pools. And in the central, in the Wainwright region there, they have medium gravity oil pools, also under water flood. So again, we're talking kind of not CO2 injection for enhanced oil recovery, but basically pushing with water flood and multiple development of targets of the Manville stock. And the south obviously is that 5,000 to 255 BOEs per day of medium gravity crude oil projects with Nelora Manville. Again, multi-lats, horizontal multi-stage fracture stimulation. We do not do fractures in oil sands, so we use SAGD. So again, you can see Cardinal Energy is a very diversified type of kind of portfolio company, right? This is very different from a company like a Mega Energy, for example. Mega Energy will have 100,000 barrels a day, SAGD only, heavy like bitumen only company. That's it. That's all they have. Like one thing, one asset, high quality, homogeneous kind of reservoirs. But you can see here, Cardinal is a little bit different, much less production, so 21,800, but very diversified portfolio. So I think they have a lot of kind of people that work there that have unique expertise in variety of different assets. I think it's pretty good maybe for employee career development because maybe you work in natural gas or light oils and you want to learn more about EOR or SAGD, and then you can use between different business units. So Cardinal is kind of a unique company that way. Okay, let's skip that stuff and go towards thermal oil project. So here you can see the talk about pipeline, and the share here that they project one is the Reford project. So we saw it on the map. And project two is the Calfield project, 6,000 to 10,000 barrels per day. And project three, delineating to be determined, and project four is assessing. So seems like they have not literally a pipeline, right? It's a project pipeline. So projects coming online. And the first one is Reford. So that's the focus of this conversation. Okay, but why are they doing that? What's the idea here? So they provide some explanation to the advantages of Saskatchewan thermal heavy oil. And you can see the Alberta map and the map of Saskatchewan. And you can see the green stuff is really where the oil sands is. This is the biggest reserve of oil sands in the world, right? I think there's like close to, 168 billion barrels in situ in that region only. And majority of the production coming from the north side of that pay, which is what we talked about before, which is mining, right? So you can see in situ mining projects. So I kind of disagree with the language there. They should have said mining projects and then in situ projects, right? You see, they should put like a comma or something because those are two different things. When you have the Athabasca, the Coal Lake trend, the Lloydminster trend, all of those are too deep to mine. Therefore, they're in situ. So you produce using SAGD, using CSS, cyclical steam simulation, but you can't mine. You can mine only on the north side of the trend. So you can see if as we go towards Saskatchewan more, they provide some thermal benefits, and they say, hey, current Saskatchewan thermal producers are Strathcona, which by the way announced a big transaction divesting the natural gas business in the Montney, Cenovus Energy, another big producer in Saskatchewan, and IPC, which is International Petroleum Corp. They have an asset in Saskatchewan, thermal asset. And they learned from these assets and these companies that it's economic to develop a greenfield project and advance it, which is what this is. And you can see that over the past 20 years, production grew from 20,000 barrels a day in Saskatchewan in situ projects, thermal projects, towards 160,000. So really big growth, right? When it comes to surface access, project timing, and reduced project cost, you have central location and existing infrastructure, which is marketing opportunity. Oil quality, they say better wellhead price at lower OPEX. attractive royalties, supportive regulator and stakeholders, proven SAGD technology, which it's commercial, and track record of success. And they say that benefit because there is project assurance, there's a timeline certainty, there's de-risk development. So there's lots of things they're comfortable with advancing because it's been done before. And they kind of know what they have. So they're trying to reassure investors that it's a good idea. By the way, in the private chat, let me know if you have any questions and we can kind of go from there. So now, cardinal thermal trend, right? We're zooming in basically from here, going more towards here. And now they tell us, hey, Reford SAGD Project 1, that's what they target. Construction of 6,000 barrels a day Reford SAGD project is underway, currently on time and on budget. And first steam expected Q3 2025. So in Q3 2025, so this year, so now we're Q2, mid Q2, quarter 2. So May, usually the way quarters work, guys, for students, Q1 is January, February, March, right? Q2, the next 3 months. And so Q3 is going to be what if it's kind of summer towards kind of winter time. Winter is Q4, right? So December, November, October, Q4, and then Q3 is kind of that August, September timeframe. Let's say in their case, the target that production to be realized, but not initially, maybe not, because they said first steam expected. And soon we will talk how first steam does not necessarily correlate with immediate production flow rates. I will explain about that. So they say, okay, well, in our channel, right? So they take vertical cores and they stack them like this horizontally on a table and say, we have actually very clean pay here. You can see that pay, right? They have defined resource, 9 legacy vertical assessment wells. So they basically put a bunch of strat wells and assessed what came out in the core. 2 assessment wells and 2 injectors drilled, 3D seismic across land base, oil column up to 20 meters. So that's their pay, which, by the way, this is not that amazing, 20 meters. Like I've seen pays close to 40 meters. The pay, guys, if you have a question like what is the pay, it's really the height of the reservoir, right? So what is that height? Because if I'm steaming that oil, how high does it go? Well, 40 meters, it's a lot. 20 meters is a lot. For reference, the height in your room, your ceiling, maybe it's 3 meters, maybe 2.5, 3 meters, 3.5 meters. Depends if you have high ceilings, right? A person will be like not normal. Typical person height will be 170, 180. A basketball player could be like 2 meters. Well, that's 10 times that size. That's big, right? So you can kind of appreciate they share that, hey, 20 meters is not actually that bad. Channel width, 500, 800 meters. Porosity, and I would actually say maybe width, but maybe they're talking about length, because usually those channels, they're very lengthy. Like those wells are very long in a sense. And internally estimated OIP, which is original oil in place, is over 80 million barrels. Right? So MM is million, 80 million barrels. So 100% working interest, so there's no joint partnership, and target depth is 650 meters. So that tells us that. So that's fairly deep. So here they have a really good slide. I really like that slide, where they compare different projects, different viscosities, and different core permeabilities. So viscosities and permeabilities are very important aspects of kind of understanding the oil flow rates and oil kind of requirement for diluting that oil. Because if, let's say, oil at 25 degrees is 100,000 centipoise, which is what you see on this chart. So if you look at the chart in the right corner where it says viscosity, think about this, 100,000 centipoise at 25 degrees. So on a very hot day, this thing is a hockey puck. It doesn't move. So they say the higher the temperature is, we can reduce the viscosity of that oil and produce it, which in this case, the required temperature has to be over 100 degrees Celsius. to exceed 100 centipoise. Now, core permeabilities, you can see they have varying permeabilities in millidarcy. So 6,000 Darcy, 6 Darcy, 8 Darcy there on the cumulative probability of the permeability. So, and in overall, they kind of aggregated said, you know what, we think it's about 7 Darcy. So 7,000 millidarcy based on that core. I don't know, it could be 6, it could be 7 based on this chart, but you know, we have precedent to maybe other assets in Saskatchewan. For example, let's take an example of one from each company. So we can say, for example, Meota West for Strathcona. It's the blue dot in the middle in the table. Right in the middle, there's a blue dot. So Strathcona would be year of steam 2020. The target zone is Lloyd, Waska, similar to what they're producing. A project nameplate, which is basically how much oil they can produce, is 10,000 barrels a day. Depth is 530 meters and average thickness 14 meters. So the pay is much lower, 14 meters. That's what they say here. And the permeability is close to 7 Darcy, so 6,900 millidarcy. And oil gravity is 10, which is very heavy API, like very heavy API 10. And impairment zone, they have bottom water at the below the pay. So bottom water at the bottom. Well, how does Reford compare it? And remember, those are commercial projects already that they've been produced, right? Well, they also have bottom water, gravity also 10, also 7 Darcy in permeability, average thickness 15 meters. So they told us it's about 20 before, right? So they said it's 20 meters here in the column, but the pay here is 15 meters. And the nameplate, which is capacity for the project, is 6,000 barrels a day. Let's use another example, maybe something slightly different. We can use Synovus Rush Lake, which is, you can see it's the fourth from right. So 2011, so a little bit of an older asset. Nameplate 24,000 barrels a day, so much larger than, right? Much larger than the proposed Reford asset. And depth is 480, so it's a little bit shallower. Thickness higher, 22 meters. Porosity 34%, similar to that. Saturation 75 to 85%. But the permeability for Rush Lake is a little bit less, so 4.5. And oil gravity is higher, 12 API. So they say here, Reford trend shows comparable reservoir oil quality characteristics to existing developed Saskatchewan thermal heavy oil projects. Okay, that's what they're saying. So let's see what it takes to build a greenfield project. When I say greenfield, it's from scratch, basically brand new, never been operated before, new facility, everything is new. So you can see they're building some facilities here, right? You can see some steam gens on the left side here where the crane is, where they generate the steam, right, through combustion, and then inject that steam to reduce the viscosity of the oil so it can be produced by gravity. So they tell us here that all 3 steam generators have been installed at Reford facility site. 85% of the facility modulars are now on lease and installed. Drilling the 6 initial SAGD well pairs concluded ahead of schedule. Construction of the 10-kilometer fuel gas pipeline and meter station have been completed. Construction of the 18-kilometer water source pipeline, right? So they need the water source to generate the steam, has been completed. A field operations team roster has been filled and are now planning commission activities. So it sounds like a lot of effort, a lot of capital, a lot of money is spent, right? And they told us this year they're going to spend another $120 million, right? So this is positive for economic development in Saskatchewan. This is positive for companies' economics. They're very open about, hey, that's kind of what we've been up to. And I think you guys can appreciate that, you know, projects like this are very complex. Now, imagine, and I've seen this in the past, you put a lot of capital, you drill, you develop facilities, you're ready to go in, you start injecting steel, the oil doesn't come, right? So we've had a company that went through this experience before many years ago. This is unlikely to happen here because they know their asset well. It seems like they did a lot of due diligence. There is a lot of comparables, but it's kind of it's a project, right? And there are some risks associated with geology and implementation and operational strategy. But of course, at the beginning, it requires a lot of capital. A lot of capital. Think about, let's say, you're a real estate developer and you're going to be housing people in a building and they're all going to pay rent, and that's how you're going to make money at the end, right? But for you to do this, you need to build a building, right? And it's not a given. Like it's a big effort. Like, and you could overspend on building that building. And by the time you rent, maybe there is no demand. Maybe nobody wants to rent in your building. So SAGD projects are not quite like that, but there is embedded risk to any big capital intensive project, right? So here basically they say, okay, we're gonna, in millions of dollars, gonna spend about 170 million on Reford project capex. That's the budget, and you can see how they've been spending money and how that money is being allocated. Source water, earthworks, fuel gas, total budget 171 million there, and spend up to date. So real project, real progress happening as we speak. This presentation I'm showing you, it's online from May. Right now we're in mid-May, so it's up to date. So you will leave it. As you learn about it, you leave it. And when you join the industry after you graduate, this will be a thing, or maybe they will have challenges, but you will know about them. Maybe you'll see in the news or something, or maybe you'll be working for one of these companies and you'll be like, oh yeah, I was like learning, doing a project about this when I learned that they were building this asset, which is pretty cool. All right. So this is their Gantt chart, kind of like what's happening over time, thermal development, expenditures, thermal production. You can see there is a step towards production and optimization. I think the next leg is probably planned for 2027. But first, they need to bring this production to 6,000 barrels a day in kind of towards 2026, right? And you can see what they're currently doing. So the question is, okay, what are you up to today? So now they just finished shop fabrications. They have field construction on site. So there are people right now, as we speak, there are people right now at Redford in Saskatchewan building something, like we saw here in the picture, right? And what else? And they're drilling and completing the wells in parallel. So when the facilities are ready, they're able to start producing from the reservoirs. So everything comes together. You can't just do like surface facilities and then no wells. Just like you can't do wells and no surface facilities, because you need facilities to handle the volumes, right? Especially when you inject a lot of steam, that steam is condensing and you produce the water back and the oil. So that's a lot of effort. Okay, so this is opportunity to talk about the technology. We have maybe 5 more minutes and then we're done. So we'll be done by 2. Redford project by numbers. So you can see NPV, why they're doing that, right? So would you do it? Net present value, 500 million. And would you spend, let's say, if I give you, let's say $170 and I told you in 3 years, it will be worth $500, or in 2 years, or in 1 year. I don't know. That's what investing is all about. You put something and then you expect a double or a triple. I don't know, maybe 10% a year or something. But they say, okay, net present value justifies the effort. So we're going to be generating value here. IRR, which is internal rate of return, 46%, project life 20 years, design rate 6,000 barrels a day, and cumulative free cash flow is about 1.7 billion. Free cash flow, it's really adjusted funds flow minus your operational costs or capex, right? And they're saying over the lifetime of this project, we're going to generate $1.7 billion. So if I was to tell you, you're going to spend $170 million on a building, and when you rent your building, for the entire cumulative gains you will have from the money in your pocket, it will be 1.7 billion. Does that sound like a good investment? And I think that's why they're doing that, right? So, and at the bottom, you always see assumptions. So they have inflation rate at 2%. Now I think it's a little bit higher, but inflation rate been coming down. WTI, they assume it's $70 per barrel USD. Right now it's about 62, 61. WCS differential 13. I think right now is about 12. Echo 225, and foreign exchange at the bottom, you can see it's 71 cents to US dollars, right? So 170 cents US will be 1 Canadian dollar. So that's their assumption on economics. And from the picture, you can see basically the technology. You drill two wells, they're parallel to each other, 5 meters apart. There is an injector well and a production well. The injector well injects steam, and that steam is rising and melting the hockey puck, if you will, in the reservoir. And what do you produce? You produce the condensed steam that just transferred that heat and the oil that was in the reservoir. You will also have some water saturation in the reservoir, right? Because remember, they told us here that the oil saturation is 75 to 85%, but full saturation is 100%. So when is the remaining 20, 25%? Well, it has to be water or some gas saturation, right? Because once you add all saturations, you get 100%. So now you're producing the water that you injected, the steam that you injected that condensed, the saturated water and saturated steam and saturated gas. And you need to handle all that stuff at the back, separate the oil from water, reuse the water to re-inject it so it becomes steam again, and sell the oil. That's why you need the surface facilities. That's why they're spending $171 million on surface facilities, right? Remember, it's like a building with renters, You build a building, renters, now you need to maintain it. But it needs to make economic sense. Here they talk about AROs and their other assets, and they have advisory disclosure here. And we're done. We talked about Cardinal Energy Reford SAGD asset that's currently being produced. And as I mentioned before, I see your question here, so I'll answer it in a second. As mentioned before, this is a greenfield project that's happening utilizing the SAGD technology, right? So I think it's a good video kind of to start, understand what's going on, and kind of go from there. Okay, so we have questions. I see an unmuted mic. I don't know if you want to say anything or. Oh, I can't hear you, but maybe type it because I don't want to type it in the private chat because I don't want to add you to the presentation necessarily. Okay, so I did see some comment. I didn't get what a cum free cash flow. Yeah, cumulated. So accumulation, aggregation, altogether. So let's say if you rent a building, renters, you collect $1,000, let's say 1 month. The next month you collected another 1,000. So in aggregate, cumulatively, you collected 2,000. After 1 year, you collected 12,000, right? Aggregation. So they say as we aggregate, as we cumulatively add all of the cash flows, the overall value we get from that $170 million we invested is $1.7 billion. Yeah, so you're good? Yeah, looks good? Awesome. Okay, so I'll end the recording right now.